Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. We are doing our Q3 market update and overview of what took place in the third quarter. Before we get to that, though, we just came out with a book.
Yes, we did.
That we authored called the Industrial Landlords Agency Leasing Guide, which is awesome.
How exciting.
I'll just quickly touch on the chapters. Chapter 1, working with the right brokerage team. Chapter 2.
Wonder who that is.
Yeah, I know it is. Chapter 2, marketing the property. Chapter 3, reporting to a landlord. Chapter 4, delivering recommendations to a landlord. Chapter 5, making deal recommendations. Chapter 6, hiring a team, how to do that. Chapter 7, success stories. Chapter 8, here's how we can help you getting your property leased. That's actually a pretty fun chapter. And then the appendix, which is the KPI performance indicator that we talk about, which is a unique thing to, I think, our team. But this was really fun to go through and write this book. You were kind of the brains behind the operation.
I wouldn't say that.
So talk a little bit about why we decided to do it.
Yeah, I mean, I think the key reason was we kept saying, what are the best practices, right?
Yeah.
We've talked about it on the podcast. We've had a few of these. But in my mind, it was never written. It's never been written.
Yeah.
And so we talked about it, obviously, as a team. Brought it up, and then we decided to write the book. I would say the main objective was a little selfish, going, how do we put it in writing what we do, and what we do well, and how we can even do it better. So we called a lot of our West Coast, leading listing brokers, friends of ours, and kind of got best practices, what we're doing, some of the stuff we want to do better, and some of the stuff that other guys and other teams and other markets are doing really well. And then I would say that the objective then was to say, let's give this to landlords for portfolio managers, fund managers on leasing assets best practices.
Yeah, and it's a segment of the business that both you and I really enjoy.
Absolutely.
We grew up in that side of the business and have continued to really enjoy it and just constantly look for ways to be different. And it's interesting because in times like now, when you start to enter into a market where it's starting to become more of a tenants type market, really good landlord service matters, right?
Yeah. Your property's not just going to lease automatically.
Yeah. In a hot market, there's not as much scrutiny on listing brokers. Whereas now when you have to get crafty and you really, have to give more and more attention to some of these portfolios, it's really important to be a good landlord broker. So I think that the timing of this is actually really, really nice.
Yeah, and it to your point, we are, and we're about to talk about the quarter, we're heading into the type of market where landlord brokers have to work hard and be creative and inventive in order to keep the listings and lease them up at the best prices with the best tenant.
Yeah, no, absolutely. So look for that. If you want a copy of it, send us an email. We can send you them. It's going to be on Amazon as well. And
in a little bit, but if you want a copy sooner, we'll send you a free one.
Yeah. And I'll sign it. I'll make sure that Matt won't. But no, it's, I think, and it's only, how many pages is it, Matt? It's 60 pages. So,
something like that.
So even me and Matt can.
I mean, how much can you write on this stuff?
Yeah.
600 pages, 3 versions.
It's one of those books you won't be able to put down. You pick it up and you gotta keep going. So, okay. So if you want a copy of that, let us know. Let's talk about Q3. It's been a really interesting, first of all, it's crazy to think that we're already past the third quarter this year.
Home stretch?
Yeah, it's the home stretch. So let's talk about Q3 specifically and the 3 most dynamic factors in an opinion.
Yes. Feels a little squishy, a little soft, maybe. Slowing down for sure, right? Not bad. We're going to go over the statistics. It's certainly, coming off of COVID, I would say, now out of COVID, well out of COVID, that was our boom years, lowest vacancies in all the Western regions. And they're starting to tick up. And you would say, oh gosh, it seems soft. But if you look at it historically, it's a very good market.
Yes.
It just is not COVID great where Inland Empire was, 0.3%, Vegas was 0.7, right? And, Seattle, I think we went down to a 3.4, right? And now climbing up to a 5.4, and we'll get there. But it just feels, if you remove those years where it was just booming for 2.5, 3 straight years in a historic way, right?
Yes.
If you look at it now, if you pull back and, and look at it over the last 20 years, it's still a very good market.
Yeah, and I think it's really important to have that perspective, right?
Yeah.
I mean, the last couple of years were crazy and just super busy on the tenant side. Vacancy, to your point, was 3.5%,
Mm-hmm.
and now we're just getting back to it's a good market, but not what it was. So
That's right.
I think we're still, historically speaking, in really good shape. So the first factor that we wanted to talk about from a dynamic factor standpoint, factor one, land values are going down, and a big part of that is a 3 times rise in construction financing, along with slower activity on the tenant side.
Yeah, so the money's not there for land, right? I would say from capital markets and, to your point, construction costs, developers are pulling back, landlords are pulling back and saying, okay, the dynamics have to be grossly different for me to buy vacant land right now, and the financing's not there on it. So land has taken the biggest beating out of everything, because if you look at the market and say it's 5.4% vacant, it's still a tenant market. There's still good demand out there. So why is land in some markets, say, dropped from $40 a foot to $15?
Yeah.
In certain, and I'm saying certain, and I won't name cities and bash certain areas of our market, but that's it. And maybe there's not a buyer at 15. Right.
Yeah. Well, it's still, and I think what you meant to say was it's still a good landlord market, but yeah, it's the financing isn't there.
The financing is not there.
And if it is, if you are going to go get financing, it's 3 times what it was, right? And so that just changes everything.
Yes.
So and you can't pencil in with a rising vacancy rate. You can't pencil in the rental growth that you've been able to in the past.
That's right.
That helped to make those numbers and make an extra $5 a square foot or whatever it was to go get that land.
Mm-hmm.
You can't make it pencil right now.
That's right.
So it's slow, and it's going to remain slow until the financing comes back to more closer to where it was.
Agreed.
So that's factor number one. Let's talk about factor number two.
Factor number two is one we've been tracking for a while, and that is the vacancy in the 1 to 200,000 foot range. It's getting better.
Yep.
Last time we reported there were 49 options market wide. There's 43, 11 of them being under construction. So we are heading in a better situation, even though that sounds horrific. That's not all competitive with each other. That's going South Seattle all the way down through DuPont, right?
Yeah. So
that's a big area. It's probably, 15 more than I'd like to see, to say, of our listings, to say, hey, we're really healthy. There's a little too many options and a few less tenants than we've been used to, right?
Yeah, definitely. Like the tenant velocity is down a little bit, which is reflective in where the vacancy rate is, right? The other thing is some of those buildings with ownership have decided to also offer them for sale.
Yes.
Which is unique, because in the past we never saw that. So I think that, those opportunities will likely trade just because there's, not a ton of options out there for sale. And so hopefully we're going to test the user market, I guess is a good way to put it, in that 100,000 square foot range, with a couple of these buildings being marketed for sale.
That's right. And of course, when we started noticing this trend about a year and a half ago, why came to mind.
Mm-hmm.
This was the sweet spot of our market. Well, it's all over the West Coast. So Inland Empire, same thing.
Yes.
Vegas, even though Vegas is the hottest market in the country, as we know, we just did a podcast on it, same thing. And why? It's because the requirements grew through COVID. So we used to be doing 1s and 2s all the time, and all of a sudden those 1s and 2s became 3s and 5s and bigger.
Yes.
And so that, what we call big box 1 to 2 is now not big box. And so it's kind of that gap. And so the developers were using historic trends to show what to build, of course, and they're building into that, but times had changed.
Yeah, and to your point, it's the bread, and the 1 to 2 has been the bread and butter of our market, right? So
that's right.
You do have a lot of product that has been built over the last 10, 15, 20 years that reflect those kind of spaces, right?
Exactly.
And so it's a deep part of the market in the sense that there's usually good tenant demand. It's also a deep part of the market, and that's where a lot of the buildings have been built to as well.
That's right.
And then the last factor that we want to talk about was that how slow the investment volume is, not only in our market, but in all the markets up and down the West Coast, really, right? So it's the slowest we've seen in our market in a decade, and we know why. It's debt and the uncertainty in the capital markets and on the debt side, and where that's gonna continue to climb to, or when it's actually going to start to stabilize. Because I think that's what we need more than anything to see the volume pick up, is people feeling comfortable about where debt is and when it's going to actually stabilize.
That's right. And the money's all chasing the same thing, short-term WALT,
Yeah.
2 to 3 year leases. They don't want vacancy. They don't want long leases. And so it really puts all the money in this tight little segment. And so to your point, lowest trades, which we'll get into the actual statistics of this, but lowest trades in a decade.
Yeah, from a volume standpoint, I think that there's going to be real opportunity, for cash buyers that are looking in markets like the Puget Sound, like New Jersey, like Southern California, like Northern California, markets that historically have been really good markets, to buy buildings at a discount to where they've been at over the last couple of years, right?
Yes.
And get back to more historical price per square foot, cap rates, everything else. So if you're a cash buyer and you're wanting to try and buy really good quality real estate in a good market, there's going to be opportunities here over the next, call it 6, 9, 12 months.
And I would agree with you, 6, 12, 9 months, because the last time this happened, that's all it was. And the few guys that ran out during that time, kind of 2009 and 10, were getting phenomenal buys because everybody put their pencils down and were chasing the same thing. Back then, it was long-term secured Class A credit, right? Today, it's different. And so if you're not running in that short-term WALT, I think there's some phenomenal buys out there. But I think it's this tight window because I think all this pent-up demand has just been sitting there waiting to see how bad this is going to get. And I don't think it's going to get that bad. I think we're there, right?
Yeah.
And I think it's going to turn around. So I think that there is a couple of quarters of opportunity to go out and buy those projects that other people aren't buying.
Yeah, because as you mentioned, once it comes back, everybody
comes
back. You
comes
start
back.
to see a few trades. Everyone's like, oh, the market's here now. And then
Boom.
Everyone jumps back in, and then the cap rates go down and
That's
pricing goes up. And
But everybody's afraid to be that guy.
Well,
right?
It's always tough to try and time the bottom of the market.
Yeah, totally. Absolutely.
Yeah, I know this. There's buildings at a price per pound that I would feel really comfortable buying in the Kent Valley right now.
Agreed.
So anyway, it'd be really interesting to keep an eye on that and what happens in the fourth quarter. So give us an opinion.
Yeah, the opinion I would say is rents are going to hold steady because we're still in a landlord market at 5.4%. Rents will hold steady through the end of this year and obviously into early next year. I would say with the exception of some pockets of that 1 to 200,000, you're going to see some discounting there.
Yeah, and I think concessions market-wide are going to be up, right? Free rent, TI dollars.
Absolutely agreed.
Yeah, so we'll see how aggressive we'll get in some of those segments of the market. So let's talk kind of big picture. You mentioned vacancy rate. Our vacancy is market-wide, and we're talking Seattle, close in, East Side, Kent Valley, Pierce County, Thurston County. Vacancy rates 5.4% through Q3. That is up from 5.1% the previous quarter from Q2.
I missed my prediction, though. I said it was going to go past 6 by the end of this quarter. It didn't happen, so that's great news.
Yeah, I don't want to see it go past 6, to be honest with you. Let's see.
Well,
so net absorption.
Well, before we jump on net absorption, I will say it's still surprising me, South Seattle. Like, biggest change in our careers in that market now at 7.5%. So that is now clearly a tenant's market and a big change from the lowest vacancy market of our whole career. In a very short amount of time, it's climbed.
So you have almost 50 million feet of product there. You have another 700 that's under construction in that market. The 2-story building.
Yep.
That will impact that market's vacancy rate, obviously.
Yeah.
It'll be,
unless somebody comes in and just immediately takes it down.
Yeah.
Which is a great project, so that could happen.
It's a great project. It's a market that traditionally has not seen bigger box tenants go there, but there's also not a lot of opportunity for big box tenants to go there. So obviously a phenomenal location too. So we'll keep a close eye on that one.
Pierce County is healthy at a 4.8.
Yep.
Right?
Yeah. There's some there's construction going on in that market,
That'll
which is
change
why
a
that
little.
went up a little bit and will probably go up a little bit more. And Kent Valley's still, about where market is.
Yes.
At that 5.4%. Net absorption.
Well,
Yeah,
I know, I missed a number earlier, but let's talk about your prediction.
Yeah.
So let's back this up to our 2023 predictions.
Yeah.
Which Bill said positive absorption would be 7 million feet, and I said 5. Drum roll.
You were both wrong. Yeah. That's so far.
So far,
Yeah.
you got 3 months left.
Yeah.
A little under that. We are, this quarter, we are negative, just under 1 million feet, 981,000 feet, for a total net absorption year to date negative 1,351,000 and change. So, Billy, Q4 has got to be about 8.5 million feet for you to hit your 7 million.
Well, the good news is I'm working on like 15 million footers.
Good, perfect.
They're all separate. They're all going to land. So I am personally going to bring that to like 10 million feet of positive absorption. Yeah, I do think there's some big deals that are going to land. I don't know. I don't think we're probably getting to 7 million. I can probably say that, but I think that we'll see some bigger deals get inked over the next, call it 30 to 45 days.
Well, remember too, and to the listener, as we say, this is a number based on current occupancy. So if a tenant signed a 1 million footer and several deals were done, large deals were done earlier this year that signed, if they're not occupying, the firm, CoStar and us and other firms don't accrue them, right? So you're right that this is not a true number, right? Because when these buildings are completed, they're coming in the next few months, I don't think a couple of them that we thought were going to get done are not.
Yeah.
So they're going to push into Q1, and so they're not going to accrue this year. That's going to throw our number off because there's a couple million feet there.
And some are, though, right? That
and
haven't been
some
counted.
Yes, absolutely.
Yeah. So we'll be fine. We'll be more like historical numbers. Probably,
maybe
3-4 million feet, something like that. And then
you said it, not me.
It'll catch up in Q1. Yeah.
All right. And then total under construction, 6.3 million feet, which is still a good amount of product under construction, right? But this does include some buildings that are obviously leased.
Yep.
Yeah.
Yeah.
So not too bad there. And then a couple of the bigger givebacks, Costco and DuPont, obviously they took another building, but they gave back 451,000 feet. Holman Logistics gave back 385 in Kent. We've backfilled that, but it hasn't accrued yet, right? Some of those.
A portion of it,
a few other deals here, but those are the big ones for the quarter. And those two deals together total just about 800,000 feet, right, of givebacks.
Yeah. And then a couple other things to note. Q3 2023 sales, talking Kings, Pierce, and Olympic counties, above 5 million, only 175,000 feet worth. There was 3 sales at just under $43 million in volume, which is low. And then that's averaging about $278 a square foot, which is in line with, kind of where we've been from a per square foot basis.
Lowest quarter, I think, in my career.
From a volume standpoint, for sure.
Absolutely.
Yeah. And then year-to-date sales, just under 1.9 million, 22 deals, 380 million in volume, which again is historically low for us, and we all have talked about why. That's a $265 average per square foot.
To put it in perspective, 380 million year to date. Over the last several years, we've kind of been doing 1.5 to 1.8 billion in transactions. So 380 million is super light.
Yeah, no doubt. Talk about port activity.
Yeah. Port activity is down. So the good news about the port activity is it doesn't directly reflect how that activity hits warehouses because a lot of that gets shipped out to the East Coast, Chicago, right? So it's getting shipped out of here. So it doesn't necessarily correlate with warehouse leasing, right?
Right.
But it is down 11% year over year. And boy, the West Coast, including LA, Long Beach, Seattle, Tacoma, are all kind of reporting very low Christmas volumes because normally this time of year, starting in August, you start that Christmas buildup.
Yeah.
So it seems like it's going to be a very soft consumer spending Christmas season based on the way firms are ordering.
Santa's going to have a lighter year, is what you're saying?
Santa's going to...
The big man?
Yes.
Yeah.
The sleigh may be battery powered now, right? So might have to lighten the load a little bit.
Yeah, well, it'll be interesting to see how the holiday volumes come in.
Yeah, they look light.
Yeah, they do look light
No
at this
port
point.
backups and down 11% right now.
Yeah.
And right now you would already have the bulk of your Christmas volume in via shipped. So it's already accounted for. So down 11%.
Yep. And then just kind of, wrapping up, we are, as we mentioned, sitting at around 5.4% from a vacancy standpoint. And, there's no hard line of saying it turns into a tenant's market at X.
It's exactly 6%.
Yeah, you say 6. I would say it's
we
more
debate
like
this all the time.
7.5, 8. But
Jeez.
it's certainly trending into a market where tenants, for the first time in a number of years, have a little more, well, not a little more, a lot more leverage than they have in years past.
Yeah. So if we, and I know we don't agree that it's a 6%, would shift it from a landlord to a tenant market, or I should say above, 6% being the slack tide, as I call it. So when it shifts to a tenant market, if it were above 6%, it'd be the first time in 8 years.
Yeah.
So that it would be a tenant's market. It's been a while, right?
Yep.
So I'm still predicting it's going there, but I think we'll continue to have a healthy market. I could see it tick to, low to mid 6s before it starts going back down. Because obviously, if it gets there, construction will slow.
Yes.
Right.
Yeah.
And then you'll start to, absorb that and go back down.
Yeah. And I think, another story is we're just seeing a lot of tenants do the easier thing of renewing their lease rather than jumping into a new building and relocating, taking a little bit more space, thinking that they can fill it. I think the 3PL market's a good example of that. In the past, 3PLs would take more space with the idea that, hey, we'll just go fill it in the next 6 to 12 months and negotiate some free rent up front, give them time to fill it, and then they'd go, take the risk of filling it. That they're not taking that risk now. The 3PL market is taking what they need today, and if they have a need for it, they'll renew, they'll go lease new space, but they have to have the need before they're willing to take on more space.
That's right. Yeah. And like I said earlier, at 5.4%, historically, this is a very healthy market. I think we got a little spoiled in a very boom time then it doesn't feel like it's as healthy, but it's historically a very healthy market. And certainly activity seems moderate, and it seems like, pre-COVID conditions.
Yeah. So it should be a great fourth quarter to keep an eye on, and the things will pick up a little bit on the investment side because, we've talked about, it's been slow. But we will be in touch. And if
Super Bowl predictions,
yeah, I got the Hawks over the Bills in the Super Bowl. Man, the Hawks are looking good. They're looking really good. Yeah, I don't know. Miami's good in the AFC. I'm sick of talking about the 49ers. There's a lot of hype about the 49ers.
They look good to me. I'd say 49ers, and I don't think Miami's going to make it there. I could see Kansas City again. I could easily see Kansas City again.
Yeah, that's a bold prediction. Patrick Mahomes goes to another Super Bowl. Yeah. Buffalo and the Hawks winning 31-17 in the Super Bowl.
When is the last time that you didn't predict that the Seahawks were going to the Super Bowl?
When they were eliminated last year. Yeah.
All right.
Thanks for listening.
Thanks a lot.